Hey traders, Jason here from Lever Brothers. Happy Tuesday. It's time for an update of my Stay the Market series. The market continues to press higher. The S&P has moved up 30 or 41 days since bottoming in December. The Dow has moved up 9 straight weeks for the first time since 1990. There, of course, have been many great trades to be had. In fact, I'd say the last 6 weeks have been the best trading we've had in years, so I hope you've done well. My goal in this video is to see if the internals support the market strength. Okay, 13 months ago when the market topped in January 2018, despite across the board new highs from the indexes, the internals were diverging from the price action. New highs didn't match the indexes, and the advanced decline lines were drifting down. So my goal here is to see how much support the market has. Are the internals strong? Is strength broad-based or concentrated? Okay, so let's check it out and see. So here's the S&P 500. If there's one thing we've learned over the last year and a half is that no move can be entirely trusted. Okay, you can see going back to 2017, late 2017, we had a straight move up, straight move down. Then we had a slow move up and a straight move down. And of course, just recently we had a straight move down and a straight move up. Okay, so we've had several sudden reversals. Now, in most cases, the internals warn us that there's trouble is brewing. So they appear sudden on this chart, but they're not actually sudden because warnings are given. But in any case, we can see that no matter how strong a market is, it could turn fast. And no matter how weak a market is, it also can turn fast. Okay, so right now we have the S&P's up, I guess you can call it, into a resistance area between 2,800 and 2,825. At this point in time, I have every reason to believe that we're going to go back to highs. Things can change, but based on what I see, I think the path of least resistance is up. Even if we do get a dip here, I think the internals are strong enough that that'll curl up. Or who knows, maybe we just press higher here and get a dip to test that range and then go up from there. I don't know, but as of right now, based on what I see, I think it's realistic to expect new highs to be hit. All right, now let's check out the internals. Okay, here's the S&P 500 up top, the 10-day moving average of the AD line in the middle, and then the regular AD line down below. So if you've watched my videos before, you know that I say that when the market is healthy, you tend to get the 10-day tends to oscillate up and down within a range above zero. There are occasional dips below zero. They don't last too long. They coincide with little weak periods, but that's perfectly normal for an uptrending market. So we got a period here in 2007. We got another period in 2018, and of course right now we're not only getting oscillations above zero, but we're getting them at an elevated level. So the market is well supported. The advanced decline line is very strong. This has enabled the regular advanced decline line to push way above its 50-day moving average, which is a really good sign. It's at a new high. As far as this indicator goes, everything is doing well. Okay, if the AD line was down here near zero, I'd be concerned. If the AD line had gotten above its 50 and had kind of struggled here, kind of like this, then I'd be a little concerned, because then if the market dipped, then it's going to kind of go like this. But it has enough of a buffer to work with. It's gone up so much that even if the market dips, it's got enough of a cushion to work with that it can fall back down to its 50, find some support, and go back up. So as of right now, this indicator says market's doing well, it's well supported, and it's built itself enough of a buffer that even when the market corrects, and it's going to correct, it can't keep going up like it is right now. When it corrects, there's enough of a cushion to work with that I expect that dip to get bought and for the market to move up again after that. Okay, so taking the advanced decline line, this is the advanced decline line of large caps, mid caps, and small caps. So what I'm looking for here is to see if there's some sort of divergence. I want to see if maybe strength is concentrated in the large caps, but then the small and mid caps are being left behind. It turns out that is not the case. So the large cap AD line made a higher high somewhere over here. The mid cap AD line, higher high somewhere over here. And now the small cap AD line finally has matched its high from over here. So I'd say this is a good omen for the market, that we don't have a big divergence. If the AD line at the small caps would have come up like this and started a flat line or something, then I'd start getting worried. But the fact that the AD line of all three size market caps are all at or above their highs. I'd say market is well supported. Okay, here's the S&P 500 versus new highs and new lows. Okay, when the market does well, you tend to get new highs oscillating at a decent level. When the market doesn't do well, obviously they're going to oscillate at a low level. The fact that new highs have been ticking in up here at a decent level, that's a good sign. Okay, when the market bottoms, new highs don't bounce immediately, of course, because so many stocks are well below their new highs. But after a couple of weeks, you want to see them start to tick up, and that's exactly what happened. Okay, so somewhere in mid-January they started to move up, and then they accelerated towards the end of the month, and now the entire month of February they've been clicking in at a pretty good level. As long as this continues, as long as we get new high prints up here at this elevated rectangle that I've drawn, the market will be supported, and I'll continue to believe that dips will get bought. And of course, you look down at new lows; they're non-existent. A warning could come if indeed new lows were starting to tick up, but it's just not the case right now. All right, like the AD line where I broke it down between small caps, mid caps, and large caps. Here's the new highs of the different market caps. So we got new highs of large caps are ramping up, new highs of mid caps ramping up, new highs of small caps ramping up. So in all cases, we have stocks of all sizes are all participating, so we can conclude that strength is broad-based. It's not concentrated in just the large caps. So as of right now, I continue to believe the market's strong, and it should continue to go up. And even if it dips, strength is broad-based enough that the dip should get purchased. Another look at new highs and new lows. This is the HighLow Differential. Okay, so you can see back here in like late 2015, this is the highs minus lows. It dipped below its 50 and then trended down. This coincided with the market moving sideways in a range for pretty much a year. If I were to back this chart up, it finally moved up in early 2016 when the market was still in a range, but eventually the high low trended up above its 50, and then the market did the same thing. So we got a cross down back here in late September, early October. I talked about this many times at the time it happened. It's been trending down since. We just got a cross up. I'm not going to be too much of a stickler here. Even if it just kind of crosses down or crosses up and moves a little bit sideways, it's fine. Okay, it doesn't have to just cross and then go straight up. But it tells me that this is a longer term indicator, and so while shorter term stuff are turning and doing well, this is a longer term indicator, and it too is starting to turn. So it'd be a good omen. A good signal if this continued. Smaller chart here, kind of hard to see. This is the percentage of stocks at a 20-day high. Okay, so we've been looking at stocks at a 52-week high. This is stocks at a 20-day high. So 20 days, this is the end of September, or this is the end of February. So obviously it's only stocks that are making a new high relative to where they were towards the end of January. And that's important because the market did extremely well from the end of December to the end of January. A lot of stocks just went straight up, and the fact that stocks are making a 20-day high means they're even taking out those highs, so it's a good sign. You can see that we're getting readings up here, 1 standard deviation above the mean. It's a really good sign. We're getting a little bit of a divergence here. You can see that as the market is pressed up, we're getting less stocks. This also happened back in January 2018. So that's something to watch out for. The absolute level is really good. It's very encouraging. So this tells you in the short term, I definitely consider this to be a warning in the short term. But overall, the indicator tells us the market's in good shape. There's a lot of stocks that are participating. Not many are being left behind, so that's a good sign. All right, one more new high chart. This is the stocks making a new high on the weekly time frame. Just want to keep it in mind. In 2016, it improved rapidly. 2019, it hasn't happened yet. What we don't want to see is we don't want to see this go up and then turn around and roll over. Okay, we want to see this thing go up and up and up and act more like 2016 and less like 2015 where it went up and rolled over. Okay, this is obviously a longer term indicator. So shorter term things are looking good. This is a much more longer term indicator, and we want it to turn, and we want it to not just turn, we want it to keep improving. Because if it doesn't, it will cap gains going forward. So here's S&P 500 versus the percentage of S&P stocks above the 20-day moving average. When the market is doing well, a characteristic of a strong market is you get prints above 50%. Okay, you'll get oscillations above 50%. It happened here in late 2017, early 2018. Again, in the middle of last year when the market was trending up, you got mostly steady prints above 50%. Of course, now you're not only getting prints above 50%, you're getting prints above 75%. This is a really good sign. Again, strength is broad-based, lots of stocks participating. You could say that this is overdone, and maybe it is, but you can't argue that this thing has a buffer to work with. Okay, even if the market goes up or dips or does something like this, we have enough of a buffer here to work with that, you know, we can see some weakness over the course of a week or two and still be in a pretty good position. Next chart, this is the percentage of S&P stocks above their 50-day moving average. 50-day moving averages, same concept applies. Okay, when the market is strong, a characteristic of a strong market is you get oscillations above 55%. In this case, it happened here, middle of last year. We have the highest prints in a long time currently. So again, like the last chart I showed you, we have a huge buffer to work with. Even if the market were to dip, even if it dipped for a couple weeks and, you know, dropped 100, 150 points, we have enough of a buffer to work with here for me to believe that the market will eventually get bought up. Okay, it's the nice thing about the current state of things is the market has done so well that it has a huge cushion to work with. Next chart, similar concept, and I'll go through these a little bit faster. Percentage of stocks above the 200-day moving average, it's at a healthy level. Okay, you draw a line through here, it's at the same level it was at during most of the middle of last year. As long as this doesn't completely break down, again, the market should be in good shape. The S&P is above its 200-day moving average, and right now about, 64% of stocks are above their 200. That's a good print. It's not an extreme print, which is fine. It's just a good print. It's a healthy print. It tells you that the trend and the gains are supported, but it's not overdone in the near term. All right. So overall, I'd say the internals are in good shape and are supportive of the market's trend. The gains maybe are a little ridiculous. The S&P is up 450 points in 2 months. This is clearly not sustainable. But the internals have done well enough to suggest the market is healthy and able to absorb some short-term profit taking, even if the market does dip, and it will. At this point, I expect a dip to get bought. Tops take time to form, so it'll take a little time for the internals to deteriorate and signal some sort of intermediate-term trouble. Thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Leavitt Brothers. If you're not getting the results you want, change something. Change the types of trades you do, change how you do your research, where you get your ideas from. Try different things until you find something that works. Come check us out at Leavitt Brothers. Perhaps we can be the key ingredient that gets you over the top. Again, thanks for listening, and I'll see you next time.